So now I know my fixed costs on a monthly basis. Let's say it's $30,000. I need to know my gross profit margin. Okay? So I'm going to continue with Paul's example just because the numbers are easy. But in his example, I knew my gross profit margin was what? 40%, right? So I know my fixed cost, $30,000 a month. I know my gross margin. So my gross margin percentage, as Sue just said, was 40%. Now what I want to do is I want to calculate my break margin here, all of a sudden becomes my net profit. Once I get past break even, my gross margin then becomes net because I've covered all my fixed costs. Does that make sense? I've got to get past my break even because once I hit break even, now all my fixed costs are paid and everything else just becomes profit. Salesperson to drive sales. Maybe we add a shift to a manufacturing operation, whatever it is. But what we're talking about is taking time out of that process from the time I either get the talent or the raw material until the time I get the sale. I want to shorten that cycle. If I can shorten that cycle, what happens? Cash flow increases, right? You have any questions before we go?